Hey y'all, it's Danielle from Black Business Boom and Black Owned Nashville, and we are live with our mortgage lending expert, Money Mitra, who has just been coming every month and giving us such amazing tips. If you've missed them, just go back and search her name. They'll come right on up. But just keeping us abreast of everything going on in the mortgage industry. And there is a lot. Before we hopped on, Mitra was like, it's a lot going on. I'm like, a lot for us to keep up with. So I truly appreciate her coming to us live to give us tips and to just keep us abreast of everything that's going on with mortgage programs and interest rates in the real estate market. How are you today, Mitra?
I am doing wonderful. Thank you so much. And how are you today, Danielle?
I'm making it. I just got finished working out. Y'all can see I still got on my sports bra, but I was like, we gotta go live. We here, we gonna do it. So I'm just happy to be here and to be able to get this amazing information from you. So we've seen a lot going on in the last few months, and the government trying to correct the market and raising interest rates, and so a lot of people, I think, are fearful right now, scared, not sure if they should make a move, if they should wait. What they're not really understanding some of the things that are going on with the interest rates. So what light can you shed on like what's going on in the industry right now, and is it a good time to even make a move?
Yes. So, you know, is it a good time to make a move? That's a great question. And, some people are saying that these are the lowest prices that we could see in the next 5 years, which means that right now is the best time to buy. But there's been a lot of concern, when rates were lower, it was a lot more competition. Home prices were raising astronomically and it just wasn't sustainable. So what happened is the government did what we call quantitative easing, where they started to increase the interest rates, which has its pros and its cons. For those that are looking in the market or actually considering getting back in, I would say it's a great time because what you're seeing right now is one, you know, there's less competition. It's going to be easier to get a home under contract. So if you were getting beat up before and you were, having buyer's fatigue, give it another try. Reach back out to your realtor, or if you need a connection, let me know and I can connect you to some amazing realtors that are getting it done in the market. But it really is a good time to brush yourself off and try again. Now, on one side of the coin, we have the situation where some people have been priced out of the market. And unfortunately, that is gut wrenching to me because I feel like homeownership, shouldn't be a luxury. It's almost like that's what it's becoming. It's kind of pulling us away from the American dream. So I want to talk about some ways that, for one, those individuals who maybe have been priced out, ways to think outside the box to maybe to get yourself back in the game. Because as interest rates go up, what happens is you no longer qualify, at the same amount. So, one, you want to consider, can you find a non-owner occupying co-borrower, someone who's willing to go on the loan with you, that you can use, their credit and their income as well. And to qualify in that regard, that will give you more, purchasing power. The other way is you're going to have to, increase your income. It can't be, if it's self-employment, you're looking at a 2-year average there. But if you're like salary, start putting yourself out there and, job hopping can actually pay off a lot these days. Some people are, shifting their income upwards, 25 to 40%. So you just never know. So that's if you've been, kind of priced out of the market. Now, if you're ready to get your feet back wet, like I said, the rates going up has actually been a good thing because there's less competition. And I know we've been, I will say, actually, very, very spoiled in the sense that, the interest rates were so low. So it's a payment shock. It's like culture shock. And even myself, looking for a home, I'm like, oh my goodness, I see what my clients are going through because all the homes that I like right now are $600,000 or more. But in my brain, I'm like, that's a $300,000 less house because, when I bought the first time, that's what it looked like. So takes a lot to adjust there. But I do like to give the advice of marry the home and date the rate. And what that means is that right now, find a home that you can commit to, that you can grow with, build with, partner with, and also keep your investor mindset in place because that doesn't have to be your forever home. After 12 months, you can turn that into a rental. I can show you how to wash that income out or the monthly payment and buy a new home. But now if you have some equity, you can pull on that. You can even keep the home. You can get a HELOC. There's so many things that you can do, but you can buy something else that now isn't more in alignment with your dream home or getting you closer to that. So we, especially in our community, if we're having harder times, getting qualified, if there's just such a gap in home ownership, we have to get out of, I guess, the materialism, the emotion of wanting this forever home, because it doesn't have to be forever. So you marry the home, but then you date the rate. Keep it in mind, this type of process is very cyclical. Yes, they're raising rates, but then the rates are also going to come down, and that's when you would refinance. But you don't want to miss out on the appreciation of the home and not buy right now just because of the emotion of the rate is too high. Because historically, these rates are still very, very low as well.
Oh God, that was a lot of great information. Like really good. Because again, a lot of people are in the space right now where they're just like, I don't know what I should be doing. But you're absolutely right. Just because you get a rate doesn't mean you're stuck with that rate forever. Now, for those that are, have homes, and I know a few months back we talked about refinance and cash out refinances. I think we may have talked a little bit about HELOCs, home equity lines, and other home equity products. If someone's looking to, make a big purchase or do some home renovations, things like that right now, is it a good time to make that move, or does it make sense to kind of wait for rates to come down for before you consider pulling any equity out of the home?
So I think it really depends on what the individual's goals are. I think, again, it's a great time because if you can add additional value to your home and continue to ride that wave of appreciation, it does make sense. Now, if someone's getting a rate in term and the rate is higher than what they currently have, there has to be a tangible benefit to doing a loan. But yes, I mean, that's where people are exploring. I have some people that go the cash out refi route, and there's some people that are going, getting a HELOC, and it really depends on the consumer. I would say, if you want a payment, if you can throw chunks at something and pay it off much faster than a HELOC, which tends to be, interest only for a longer period of time, that can be a great tool for you to get to where you're going. If you want something that goes towards principal and interest, it's included in your mortgage payment, you're breaking it down over time, and it's, taking care of itself in the amortization. That's a great way to go as well. And, I will tell you, the interest rates even right now are lower than they are, for personal loans or other types of loans that people often use, for home improvement. So right now, some people are also electing, they're like seeing the prices in the market. They're like, wait, rather than selling my current home, I'm just going to redo the home that I have right now and bring it up to, what I desire. And I think that's a great way, because I mean, you already have a love for the home, memories, emotions, all that. But then you also can come in, get connected with the contractor and increase the value and get it to what you want it to be, in 2022.
Absolutely, I love it. So there's some new products out, and I don't think that, other than talking to you, like most of us are not really in the know about the fact that there's so many different mortgage products out here. And so we
Right.
just think about kind of the traditional mortgage and what we know to be the qualifications for those traditional mortgages. Can you tell us a little bit about, some programs that may be available now or coming up that we may want to, that may suit the needs of some of the folks that are tuned in?
Yes. So one thing program I want to tell you about, we talked about, a conventional product, down payment assistance, FHA. But one of the biggest caveats when dealing with DPA or down payment assistance is that the DTI, or the debt to income ratio, is very strict and capped at, a 45% or a 43%. And so for those of us, that have some additional debt, that have, student loans, things of that nature, we need a little bit more room. So there are some, new programs that are available and some that are coming down the pipe that I want to tell you about. And, feel free to reach out to me, complete an application. We can see, what is a good fit for you. But it actually allows for higher debt to income ratios, based upon, your credit score as well. And so in some of these situations, rather than being capped at 43 or 45, you can go all the way up to, 55 or 56%, which is, a significant difference if you understand DTI, or debt to income ratio. And what DTI is, just to run that back for those of you, who this may be the first time you're hearing about it, it's the debts on your credit report, the monthly debts, added up plus whatever your new mortgage payment would be divided by your monthly income. And so we as lenders have guidelines that have certain ratios. And like I was saying, for those of us who need some help with the down payment. We have down payment assistance programs. Those are typically capped at a lower level, 43 or 45. These programs now can, as long as you qualify, get you up to like 55 or 56%. And there are even some tiers in between that from the 43 to 45% as well.
That's huge because, like you mentioned, student loans are hanging over a lot of our heads where it's like, if that's a consideration, just count us out. Like if you got the student loans, we just ain't gonna qualify. So to have some flexibility in that and some other options is huge. Because when you have 100,000, 200,000 in student loans, that that's a huge amount of debt. That's a lot of debt. So
Mhm.
that is amazing. Wonderful information today, as always, Mitra. Anything else you want to make sure that we know about before we wrap up?
Yeah, so I do get some messages sometimes about, I am self employed, I'm an entrepreneur, and I can't get one of these traditional loans. And I know that has caused a lot of frustration. One of the great pros of being self employed is you can take a lot of write offs. And, but then what happens is you kind of, knock your income down to nothing on paper, even though you're making money. So I also have access to an entrepreneur loan where what we do is we pretty much take your bank statement. You can be an independent contractor, entrepreneur. We're going to need, somewhere between 12 to 24 months, depending upon the situation. And we will actually look at the deposits of your income into your bank account, your personal or your business bank account that's coming from your business, take an average and use that for your income and not include any tax returns. So I think that that's a big game changer for some of you guys that have
That's
been,
huge, Mitra. That is
in the
huge.
weeds about it.
Man, that is huge because, again, now I don't want that to make people feel like, well, I'm gonna just keep taking these write-offs, because that's one of the things that I try to, when I talk to business owners, I try to encourage them to not intentionally write off so much that they're now looking like they're not making any money on their tax returns. And that's something that very early in business for me, 10 years ago, that I don't remember who, but someone kind of ingrained in me, like, you can just write all this stuff off and then you don't have to pay as much in taxes.
Mhm.
And then as I became, more astute in business, I started to understand this can help me to avoid taxes today, but it can hinder me from even buying a car, and getting a house in the future. So I think it's really important that we're careful about trying to avoid taxes. But then there are also cases where the taxes, what's showing up on that profit and loss, and the taxes is just are not a good indicator of like how well we're actually doing. If you're
Right.
paying yourself, $10,000 a month, but then your taxes are not, are showing that you took a loss, or you only made $25,000, then things are just not mathing for us, and putting us in a
Math ain't
situation.
math.
The math is not math. So that is huge because, again, many of us, we are paying ourselves, and we can show the deposits, but we can't. But our taxes are just not aligning with
Right.
that. So that is huge. I will be sure to tell all the entrepreneurs I know about that option, because it,
And I
it
think
definitely
there's
can
a
be a
difference
struggle.
between like abusing writing off expenses and the
Mhm.
expenses are the expenses.
Yeah.
So this gives just a great opportunity, like I said, for entrepreneurs and independent contractors to get out of that traditional, mortgage swamp, because it's like, this is not working for me. It doesn't fit. And so I'm glad that these, more creative, unconventional routes are coming out to make sure that, more people can get financing. Now,
Yeah.
the terms of it may not be, as favorable, just like with down payment assistance, you tend to
Mhm.
see higher interest rate, but it gives you an option to get in the game. And people that understand business know it's about leverage. Like, honestly, the rate is the rate. Sometimes, does it even really matter? To a degree, yes, but
Yeah,
as
you
long
just need to get it done. Yeah. Yep. I love it. Wonderful. Again, great information, Mitra. How can people reach you if they are interested in, learning if they qualify, learning more about some of these programs, learning if there's a program that's a fit for their situation? How can they reach out to you?
Yeah, so feel free to shoot me a text message. You can contact me on Facebook, send me a direct message on Instagram, on Facebook. My name is Mitra Corinne Sharifi. On Instagram, you can reach me at Money Mitra, and you can text me or call me at 256-658-1760.
Fantastic. And you can always go to moneymitramortgage.com. It's very easy to remember. Wonderful. This was wonderful, Mitra. Thank you so much for coming and joining me. And we got another session coming up. So I'll definitely see you then. Thanks.